We welcome our viewers from all around the world. I'm James Lawrence. You are watching Ace Once News TV. The U.S. Federal Reserve has made a significant move in its ongoing battle against inflation. The Fed has cut interest rates by 0.5 percentage point, the first rate cut since March 2020. This bold decision will bring down borrowing costs for everything from mortgages to credit cards, providing much-needed relief for American households and businesses. This move signals urgency from the central bank as it works to boost the economy while still keeping inflation in check. Inflation has fallen sharply from the 40-year highs we saw in 2022, and so far, the Fed's measures have avoided tipping the economy into a recession. However, not all Fed officials were in agreement. Governor Michelle Bowman preferred a smaller rate cut, highlighting ongoing concerns about price pressures. The Fed also expects unemployment to rise slightly to 4.4% this year, up from the current 4.2%, while the central bank has managed to cool inflation without causing a spike in joblessness so far. Many are wondering if it's acting too late to prevent further economic strain. Mike Elton is here to explain what it might mean for the world. Mike.
Thanks, James. In a monumental move today, the Federal Reserve cut interest rates by 0.5 percentage point, marking its first reduction since March 2020. This bold decision comes as the Fed faces growing pressure to lower borrowing costs for American consumers and businesses. So, what does this mean for the world economy? This rate cut signals a new phase in the fight against inflation, one that could bring relief globally. For instance, countries with economic ties to the U.S. might see similar trends in their borrowing costs. Emerging markets, which often rely on U.S. interest rates to guide their own financial systems, could experience shifts in investment flows and currency stability. The global ripple effect could also be felt in international trade. Lower interest rates typically weaken the dollar, potentially making U.S. exports more competitive on the world stage. On the flip side, countries reliant on U.S. investments could see capital flows shift, leading to currency adjustments and possibly inflationary pressures. The Fed's decision also raises questions about global economic recovery, as nations dealing with post-pandemic economic hurdles watch closely. With inflation slowing but unemployment projected to rise, central banks around the world might adjust their strategies to avoid overheating economies or facing unexpected downturns. So, this move is likely to influence global markets, international trade, and currency values, setting the tone for how other central banks might react in the months ahead. James?
Thanks, Mike. We will be right back.